Hey, good evening, everybody, and thank you for joining us on this Bitcoin and the Evolution of Money webinar with our special guest, Jonas Benner from the AMP investment team. Welcome, guys, and thank you for joining us. We might just wait a couple of minutes before we get started, but we won't wait too long. So give us a minute or two, but I reckon so we can get going. Hope you've all had a good day today. I'll run through some housekeeping in a moment. But thanks, Joy and Jekyll, for doing the facilitating in the background today. I think we might just get started anyway with some housekeeping. So hope you can hear me all okay. Let me know otherwise, Joy. Okay, so get some housekeeping out of the way. Firstly, during the presentation, we'll have everyone's microphone on mute and cameras turned off until the Q&A section, which we can open up for all. Now, in the meantime, you do have a chat box that if you do come up with a question that you want to ask, by all means, pop that into the chat box and we will answer that at Q&A time. All right. Secondly, Jonas will run through his presentation, then hand over to myself just for a few extra slides. But we should all get through that within the hour and allow 15 minutes or so for some Q&A. I'll have a couple of questions too. So, but before we do all that, Joy, can you throw up the importance notice slide? So, whilst this may be amazing, it is not financial advice. It is for general information and educational purposes only. It does not constitute personal financial advice and does not take into account your individual objectives, financial situation and/or needs. Before making any investment decisions, you should consider seeking advice from a qualified financial advisor like Arthur P. from FMG. All right, so we'll just get back to, for those that have just joined us, we're just running through some housekeeping duties, but I think we'll get started. I'll introduce Jonas in a moment, but I think it's probably good time just to, before we hand over, for some context. Now, I first discovered Bitcoin some 11 years ago, back in April 2015. Funny enough is when we started FMG. And I simply dismissed it. In fact, I ridiculed it. Now, how wrong was I? Because back then the price was $300 per Bitcoin, Australian dollars, and now it's over 100K with an all-time high of about 195K back in October 2025. Now, it wasn't until April 2022 when I was looking for some CPD, some continuing professional development hours to study, I came across Monochrome Asset Management's research and started reading and thought, okay, well, this is some reputable stuff. I can get some CPD points and learn. And the more I sort of went down the rabbit hole, that 4 years ago, well, now 4 years on, I've done some 600 hours of study on this topic. And you may or may not have heard, but Warren Buffett had a great saying that, funny enough, he shared when Debbie and I were in Omaha, Nebraska, back in May 2019, some 7 years ago. We attended the Berkshire Hathaway AGM. That's the annual meeting that they have. And he did share that if you weren't prepared to invest a minimum of 500 hours to learn about an asset class, let alone an asset, then you shouldn't be investing, which was interesting. But the last 4 years, there's been some learnings. And one of the things that I have learned is that everyone goes through 4 out of 5 stages. Some people get to stage 5 of understanding Bitcoin. Stage 1 is to dismiss it. As I mentioned, I had, in fact, ridiculed it. Now, stage 2 is when we deny it. We say things like, it's too good to be true, it's going to be hacked, the government's going to ban it, it's used by criminals, and so forth. And then you move on to stage 3, and it's like all about, it's a speculative investment. So you know, I wouldn't invest anything more than you're prepared to lose and gamble on it. But then you move to stage 4 and you realize it's a tech play, and you think of it as more as an investment, just like you would have invested in Amazon, Apple, Facebook, Google back when the internet started. And if any of you may have caught yesterday's newsletter that we put out about identifying patterns and the patterns that Bitcoin is following in relation to the internet. But then you may eventually get to stage 5. Now, stage 5, I think you need to have studied more than 100 hours, and you realize that, oh my God, Bitcoin is good for the world and can fix the money problem. So it's no secret I'm at stage 5. And if you don't, I'm sure Jonas is well and truly on stage 5. And if you've asked me before discovering Bitcoin, oh yeah, I might retire in my early 60s. But now 4 years on, I still think we've got another good 10 years of work during what we are calling the digital gold rush. And before it becomes normalized and boring. Because once it's got to normal and boring, I think my job will be done. So enough about me. It's time to introduce our special guest speaker, Jonas Benner. Now, Jonas is a senior quantitative researcher at AMP and was instrumental in seeing Bitcoin adopted in their investment portfolio within AMP Super. And the slide you're going to see is probably a good sample of what he had to do to convince the board of AMP to take some exposure to Bitcoin. And I think that's been a really good decision because their super funds have performed quite well. Now, Jonas has been a much sought after speaker on the topic of Bitcoin, not only around the country, but last year he was fortunate enough to be a keynote speaker at BTC Prague, and that's the premier Bitcoin conference in the center of Europe. So without further ado, over to you, Jonas, for your presentation.
Thank you, Arthur. Can I turn my camera on as well? Yes, I can.
Yeah.
Hello, everyone. The reason why I'm going to go through this is that in order to understand the investment case for Bitcoin, which is also what I presented to the board of directors at AMP, you need to understand everything that I'm covering here today, and in my opinion, because without understanding, you know, the most important aspects of money and the evolution of money and how we got here, it's really difficult to see the investment case for Bitcoin. And having all of that context is really the foundation for understanding Bitcoin. Topics that I'll cover off today is, first of all, how Bitcoin fits into the evolution of money. Then we'll talk about Bitcoin's case as a store of value. Then move on to the part that I think is probably very interesting for a lot of people here, which is Bitcoin's role in a portfolio and how we at AMP also see Bitcoin's role in a portfolio. And then lastly, one thing that I always do is make a distinction between Bitcoin and the rest of crypto, because oftentimes this gets put into the same bucket called crypto or cryptocurrencies. Whereas I think it's actually really important to understand that Bitcoin and all of the rest of crypto are very, very different things and have very different investment cases as well. And not a lot of people know this, so it's important to cover that. So yeah, let's move on to how we even got to Bitcoin in the first place. And this here is a bit of a simplified version of the history of money, but it looked roughly something like this. And before I get started talking about each step in the evolution of money, there are two things that I want everybody to understand here, which is that, first of all, money doesn't actually have to be something that is issued by the government. This is really only a fairly recent phenomenon and has only been the case since we've introduced gold-backed certificates. And before then, money has always been something that naturally arises in human societies as we try to find more efficient ways to trade. The second thing that I want you to understand is that in each iteration of money, we improved on some of the shortcomings of a previous form of money, and only then moved on to the next step in money. So we started off with bartering. Bartering is just direct exchange of goods, where someone, if you have apples and you want bread, and someone has bread and wants apples, you can make that trade. But the problem with barter is that it requires what's called the double coincidence of wants. That trade only works when you have what the other person wants, and the other person has what you want, which is really hard to standardize, and it doesn't scale very well. Which is why we then moved on to using collectibles, which were more universally accepted. And those were things like seashells, glass beads, limestones. At some point, we were even using cattle or salt as money, because they were rare and culturally recognized and became the earliest forms of stores of value that we had. But the problem with collectibles was that they're not scarce enough, and they can easily be inflated with better technology. And then once trade became more global, that global trade made stores of value from different societies compete with each other, which eventually led to gold winning out because it had the best store of value properties and therefore became the dominant monetary layer used all over the world. At some point, we were using silver as well, just because gold packs a lot of value into not a lot of matter, and therefore is really difficult to use for small transactions. And we were using silver for smaller transactions and gold for storing value at some point. Now, the problem with gold, though, was that it's heavy, inconvenient to transport in large amounts, and difficult to divide into smaller units. And the way that we overcame those shortcomings, which is actually a really clever solution, is to introduce gold-backed certificates, which are backed by gold and are far easier to transport, store, transact, and divide. But the problem with them is that they require trust in the issuer, because if someone holds a lot of gold and is issuing gold-backed certificates against that gold, then they have to first of all hold the sufficient gold and honor redemptions when you want to redeem your gold-backed certificate against gold. And that trust at some point always became broken. Now, there was one other issue with the gold-backed certificates, which is that the rigid monetary supply limited governments and central banks in their spending and flexibility to manage the economy. So this wasn't necessarily a problem with the gold-backed certificates themselves. It was from the perspective of governments and central banks. This was a problem because it limited them in what they could do and how much they could finance wars and stuff like that. Which is why at some point they then introduced fiat, or government decreed money, which is the money that we use today, which removed that gold constraint. And that really happened after 1971, when Nixon took the US and effectively threw the whole world off the gold standard, which allowed for far easier expansion or contraction of the money supply. But the biggest problem with that is that an unlimited supply can lead to inflation and currency debasement and requires really deep trust. Now, as you can see in the evolution of money chart here, there's a question mark above the step from fiat to Bitcoin. And the question is whether Bitcoin is the next step in this evolution of money. But what does Bitcoin even introduce? Bitcoin introduces digital scarcity, decentralization, censorship resistance, and trustless global value transfer. And at its core, it really seeks to combine the best traits of gold scarcity with the portability and divisibility of fiat without needing a centralized issuer. That's really the essence of what Bitcoin introduces and why Bitcoin was created by Satoshi, who invented Bitcoin. And Satoshi essentially realized that gold had a lot of benefits that fiat didn't have. The scarcity and being controlled by no one were the key ones, but it lacked the portability, divisibility, and easy verifiability required to stay money in this increasingly globalized world where information and therefore trade can travel at the speed of light. He also realized that fiat improved upon these shortcomings, but sacrificed the key properties of gold as a result. So his solution was to combine something or create something that combines the best properties of both and actually improves on the properties as well. Now, another thing that's important to understand about money is that an ideal money should fulfill three functions. And they are medium of exchange, meaning that the money is widely accepted as payment for goods and services. Unit of account, meaning that goods and services are priced in it. And the third one, store of value, meaning that it retains purchasing power over time. And gold actually used to fulfill all of these roles, but then ran into the issues that we talked about. The problem is that today's money, fiat money, fulfills the medium of exchange and unit of account roles. You know, here in Australia, you can use Australian dollars to pay for things, and everything is priced in Australian dollars. But it fails at the core function of money, which is the function of storing value. Australian dollars don't retain purchasing power over time, and neither do euros, neither do US dollars. No fiat currency does that. Especially in the last couple of years, we really all felt the impact of that. Like if you go to Woolies now and spend $100, that $100 doesn't buy you the same stuff that it did before COVID, especially, I guess. So because fiat money fails at this core function of money, people have moved on to using other things as stores of value, stuff like shares, real estate, gold, art, and other collectibles, because they retain purchasing power better over time. Thinking about these three functions of money, the store of value function is also exactly where Bitcoin comes in, because an emergent store of value in an increasingly digital world is the most compelling investment thesis for Bitcoin. And that's the one that I see for Bitcoin, and that's the one that we see at AMP for Bitcoin as well. The other thing that's maybe important to mention here is that looking at the functions of money and talking about Bitcoin as money, a lot of people criticize Bitcoin and say, well, how can Bitcoin be money if I can't, buy my coffee with Bitcoin yet? And that kind of misses the point for two reasons. First of all, technologically speaking, Bitcoin could become a medium of exchange quite easily through stuff like what's called the Lightning Network. Although that's not that important, so I don't want to focus on that too much right now. But before that can even happen, what's really important to understand is that before something becomes a medium of exchange, it actually needs to become a stable store of value first, which makes a lot of sense when you think about it, because why would a merchant accept a money like Bitcoin right now that's fluctuating in value a lot from day to day? They would prefer something that's relatively stable. And we also learn this when we look at the 4 stages of monetization that monetary goods in the history of humanity have always gone through. And here the important thing is that this only applies to money that emerges naturally in a free market competition by being selected by the people. It doesn't apply to fiat currency, which the government essentially forces us to use, but to all forms of money that are naturally selected through free market competition in history. They started off as collectibles, and once enough people collected something, it was recognized as a means of keeping and storing value, which also meant that its purchasing power rose as more people demanded it, until it plateaued when it was widely held. Only once the purchasing power stabilized, the money could then be used as a medium of exchange. And this may take decades or centuries. In gold's case, this took a really long time, but at the time, the world also wasn't as hyper-connected and as fast-paced with the internet and stuff like that as it is today. And once money is a medium of exchange, then goods usually become priced in it straight away. So that last transition happens almost instantaneously. But when we then think about where we most likely currently are with Bitcoin, is still in the phase where it transitions from being a collectible to a store of value. In the early days, Bitcoin was held by cypherpunks and, hackers and programmers on the internet that liked it for the cryptography and like the cool technological aspects that it had. Whereas now, slowly and slowly, more and more people are starting to recognize it as this new store of value, kind of like digital gold. I mean, in the US, we have Scott Bessent, the Treasury Secretary, talking about Bitcoin as a store of value. Ray Dalio is talking about it like that. Larry Fink, the CEO of BlackRock. Like more and more people, big people in the world of finance, but also heads of nations and central banks are starting to talk about it like this. So just to reiterate the point, an emergent store of value in an increasingly digital world is the most compelling investment thesis for Bitcoin right now. And that's what all of this is focused on. Just one other quick chart to show why fiat money is not a good store of value anymore and why it fails at that function. This here is a chart of the purchasing power of the US dollar, arguably, the strongest of the fiat currencies over the last 100 years. And it only goes up until 2020. But the point is the same, which is that over those 100 years, $1 lost roughly 97% of its purchasing power. And there's a lot of different events that happen along the way here, but I'm going to spare you that history lesson, but that just shows you, you know, $1 from 100 years ago buys only 3 cents worth of what it used to buy back then, essentially. So with you know the history of money and the functions of money introduced, let's actually talk about Bitcoin's case as a store of value. And the one thing that I like to go through here is this thought experiment. The question, if you could design the ideal store of value, what properties would it have? And you know, if we had enough time, we could pause here and actually do some brainstorming and run through this. But because we don't have that much time, I'll just go to the properties in the next slide. But I think this is a really good exercise to go through in your own time, if you know, if you want to. And the properties are the following. Like, this is a long list of properties. I'm not going to focus on every single one here. This is based on a German investment advisor that I follow quite closely, who's actually gone through this exact exercise with dozens of family offices in Europe. And these were all the properties that they collected. And some of the most important ones are that there should be no inflation possible, which means that your stored wealth and purchasing power doesn't get diluted. Obviously, it needs to be divisible because you want to be able to do small and big transactions. It should be liquid and portable, meaning that it's easy to trade in and out of that store of value, and you can take it from A to B very easily. You can take it from Australia to Europe or to the US if you wanted to. No or low cost of storage was one that I found quite interesting, because storing your wealth, just holding it, shouldn't eat into the purchasing power that you're actually storing. It should also be durable, and ideally it should be infinitely durable or indestructible. Have unlimited capacity. That was also an interesting one, because you know, people have different amounts of wealth that they want to store in something. Someone might only want to save $10 or $50. Somebody else might want to save $50 billion, and both of those things should be equally possible. Egalitarian rules was also an interesting one that I didn't really think of before seeing this list, which means that nobody gets special rules, access, or privileges just because they have more money. And then, you know, it should also have a track record, ideally. Now, if we actually rate existing stores of value on these key properties, and here I'm looking at gold, fiat money, real estate, shares, and then also Bitcoin in the middle, we can see that Bitcoin clearly outperforms all the other stores of value on these key properties of what an ideal store of value would need to have. And one interesting thing to point out here is that gold and fiat money actually complement each other quite well in a lot of these properties, which is why gold-backed certificates were arguably the best solution that we had thus far. Another thing that I thought was quite interesting is that property or real estate, from first principles based on these properties here, is actually quite undesirable as a store of value, because it's not divisible. You can't just sell a small part of your house if you need money. It's not portable. You can't just take your house with you. It's also not liquid. You know, buying and selling houses takes a long time. No or low cost of storage is also not given, because you have to pay maintenance costs and stamp duties and other taxes. It's not accessible anywhere. It also doesn't have egalitarian rules. A lot of people, especially here in Australia, are getting priced out of the housing market, or you're required to have a certain credit score before you can even, you know, take out a mortgage to buy a house. And it's not fungible. One house is not equal to another. So from first principles, based on these properties, real estate is actually quite undesirable, which I thought was an interesting insight from this year. Now, just looking at this list, some of you are probably thinking, okay, Jonas, I understand why these properties are important, but didn't you forget at least one that's really important, which is stability? Because this is supposed to be a store of value after all, and how can Bitcoin be this ideal store of value if it's so volatile? And my response to that would be that stability, or the lack of volatility, is not an intrinsic property. Just like, you know, volatility is not an intrinsic property of anything. It's a consequence of market or human behavior. It's basically a consequence of how we humans trade something, but nothing is inherently volatile. That's not like a property that something just inherently has. And stability is the result of something being an established store of value with the best store of value properties, but that also requires broad adoption, liquidity, and market confidence, which would lead to reduced volatility over time. Now, the interesting thing is that if we actually look at the 1-year rolling volatility chart of Bitcoin versus the Bitcoin price here, we can see that the yellow line, the 1-year volatility, has actually come down a lot over time as Bitcoin's price has gone up a lot. And I would expect that to continue further as Bitcoin's adoption rises more and more, and more institutions, more nation states hold Bitcoin. The volatility would decrease over time. Now, one other property that some of you might be thinking about looking at this chart, and especially because I talked about real estate, is that maybe you want your store of value to generate a cash flow. That's one key reason why people buy a property or real estate here in Australia and everywhere in the world. And what I would say to that is that, as we say in finance, there is no free lunch. You can't get something for nothing. Like, that's not just a law in finance. I feel like that's a law of nature almost, that, like, if you're getting something that can't just always be free, something can't just be paying you a yield just for existing. And if an asset is paying you something, that yield has to come from somewhere. And yield is usually compensation for either risk or temporarily relinquishing control of your asset. If you think about a rental property, you have to manage tenants, you've got maintenance costs, you have to abide by local regulations. Technically, a tenant could destroy your property as well. Even for equity dividends, you rely on company performance and board decisions, and dividends can be cut at any time. And when you think about, what a pure store of value should be, Bitcoin and gold are kind of the only two examples of that. But it also means that neither of them inherently produces a yield just by existing. But a true store of value is something that people seek because they don't want to rely on any counterparties or external factors. They simply want to hold an asset that preserves their economic energy over time without any additional complexities, contracts, or risk exposures that typically accompany yield. And that is what saving is supposed to be. Like, that's what saving actually means. You just hold something, and that maintains your purchasing power, your economic energy, without any additional risk that you have to take on. And that's what a true store of value should be. Now, one ethos that's very big in the Bitcoin space is the saying here, "Don't trust, verify." In Bitcoin, we say that because if you run your own node, you can verify everything on the Bitcoin blockchain yourself, and you don't have to trust anybody. No third party, no central party, no nothing. You can verify everything yourself. And I want you to apply that same ethos to everything that I'm saying here today, or that Arthur is saying here today. Think about all this stuff yourself. Like, if you go through that exercise or that thought experiment, if I could design the most perfect store of value, what properties would I give it? And come up with your own list. Or maybe you don't agree with the list that I had, or you think I rated something differently to what you would have done. And maybe even think about stores of value that you're currently using, and what properties that they have that to use a disadvantage, and what property they would need to have so that they don't have this disadvantage. And then feel free to reach out to me anytime, and we can always have a chat about that. But that's just one thing that I guess I always tell people, that is like, just because I'm excited about Bitcoin, or because in my head, Bitcoin is an ideal store of value, that I don't want anybody to just take my word for it without independently coming to that conclusion themselves as well. So that's very important for me. Now, one other insight that I want to share here, or one insight from studying human history, is what I've called the evolution of problem solving. And the way that I think about this is that we humans are problem solvers. That's how we've built the advanced civilization that we have and progressed as far as we have. And the typical pattern that we see here is that we encounter a problem, we then initially misuse or repurpose some kind of existing solution as the best available fix, until someone comes along and engineers the perfect solution, which is actually made purely to address that problem. One example would be that we can't see in the dark. So what we initially did is we repurposed different versions of fire. We were using candles, actual fire, and torches. But each of those solutions was risky or imperfect in and of itself. A candle doesn't produce a lot of light, for example. A fire produces more light and heat, but it also creates smoke, and it can be dangerous if it gets out of hand. And the torch is somewhere in between. So what people did back in the day, if you think about like a king in a castle a couple hundred years ago in Europe somewhere, he built a diversified portfolio amongst those repurposed solutions because they complemented each other in different scenarios, but they were all imperfect or risky. Until Tesla, Edison, and others came along and developed electricity and the light bulb, and now over 99% of modern lighting is electric. Another example is that long distance communication was slow and unreliable. So initially we repurposed smoke and created smoke signals. We had horseback messengers, we had letters, we sent pigeons, telegrams, until someone came along and engineered the internet, which is now the backbone of 99% of global communication. Another example is that food spoils quickly in warm environments, and our repurposed solutions for that was salting food, digging cellars because it's colder underground, using ice blocks, until someone engineered the electric refrigerator. Now, you're probably seeing this and thinking, wait, how is this related to Bitcoin and the whole investment case again? The pattern that I want you to recognize here is that we initially repurposed existing solutions because they were the best available fix, but they weren't actually the perfect solution for the problem that we were trying to solve. They were something else that we repurposed until the perfect solution came along. And then 90+% of the time and energy and money that flowed into these repurposed solutions was captured by the perfectly engineered solution. Now, if we think about one of the oldest problems that humans have always had, which is the problem of storing value. How do we store wealth in a way in which it maintains its purchasing power over time and ideally generations? And we also know that we're currently repurposing existing solutions as the best available fix, like shares, real estate, gold, art, and other collectibles. But we know that technically they are different things that aren't really supposed to be stores of value, but they are the best available fix that we have right now. Like shares should technically just be fractional ownership in a productive enterprise. Real estate should be a place where you live or where you do business. Gold, again, is probably the most pure store of value, so it does fit most cleanly into that perfect solution, but it's not made for the modern world anymore. And then art and collectibles is again something that is maybe nice to look at, or if you're talking about old timers, that's still technically a car that should be driven, and that's something that should be storing value. And based on the table that we saw earlier, where we compared the different stores of value on the key properties of an ideal store of value, there's a strong case that now someone came along and engineered the perfect solution. Just like we got the internet and the refrigerator, somebody now created Bitcoin. And I'm not saying that, 99% of all the value that's sitting in shares, real estate, gold, art, and other collectibles will be captured by Bitcoin. But what if Bitcoin really is almost a perfectly engineered solution to the storing value problem? What if it's 10%? What would that actually look like? And this table that I have here is a bit outdated because gold's market cap is a lot higher, and all of it is probably a little bit higher, but the logic remains the same, so just bear with me. If we actually look at the different categories of assets that people use for storing value and then sum up their total addressable market in US dollars, and this is trillions of dollars here, that total is roughly 900 trillion. If we assume that around 50% of that represents either monetary premium or store value function, then that's still a total addressable market of 450 trillion US dollars. And if 10% of that flowed into Bitcoin, then that would be 45 trillion divided by 21 million, because that's the maximum Bitcoin supply, which is 2.1 million US dollars per Bitcoin. And as I said, these numbers are a bit outdated, so they would probably even be a bit higher right now. And the way that the person that created this table originally did that is they thought about the potential capture of each of these categories by Bitcoin and then did a bottom-up calculation, and they actually got to a total addressable market for Bitcoin of 200 trillion or 10 million US dollars per Bitcoin, but I wanted to be a bit more conservative than that. ARK Invest actually did something very similar in 2022 in a presentation, so I just thought I'd share that here, where they looked at different use cases for Bitcoin, like a remittance network, nation-state treasuries, maybe seizure-resistant assets for high net worth individuals, corporate treasuries, and digital gold, and then did a similar bottom-up summation, and they got to $1.36 million per Bitcoin by 2030. I'm not sure if they've changed that yet. I haven't actually checked, but they probably would have revised that a little bit because we're approaching 2030. But even, and again, this table here is a bit outdated because these are just the slides that I used when I presented to the board of directors at AMP last year, which was basically exactly 1 year ago. But even if we think about Bitcoin just as a competitor to gold, and if Bitcoin competes with gold and replaces it as the dominant non-sovereign store of value and breaks even with gold's market cap, what would that have looked like 1 year ago? At the moment, it would probably look even better for Bitcoin, I guess, because gold's higher and Bitcoin is lower. But at the time, that would have roughly been a 10.5x or an implied price of $1.1 million per Bitcoin. But because Bitcoin is at below $80,000 right now, and gold is at like $4,500 right now, it would be a lot higher, maybe like a 15x or something like that. And to some of you, that might seem a bit out there because gold has been around for thousands of years. Central banks all over the world hold gold. Gold is used in jewelry and all those other arguments. But let's actually look at a few charts that show the interest in Bitcoin versus gold, at least based on ETFs. This first one here is the assets under management of BlackRock's ETF for gold in the black line, and Bitcoin in the orange line here. And this is only the first year of data because I got this chart at the end of 2024 when only 1 year of IBIT, the Bitcoin ETF, was available. But what really struck me about this comparison here is that it took the gold ETF 20 years to accumulate $33 billion in assets under management. And the Bitcoin ETF accumulated almost double that just in the first year. And if you look at the slope of those two charts here, I mean, it's a completely different story. Another way to look at this is to look at the ETF inflows by year for all of the ETFs, which Bitwise collected. And as we can see, the first year for Bitcoin was a lot higher than the first year for gold. I mean, we could see that in the previous chart as well. There should be data for year 2 now, which I haven't looked at yet, but it still would have been a lot higher than the year 2 for gold. But the interesting pattern to recognize here is that for gold, each consecutive year after year 1 had higher and higher inflows until there was a massive year in year 6, but even year 7, 8, and 9 was substantially higher than year 5. And what if something similar happens for Bitcoin, where there's more and more interest by institutions, individuals, whoever wants to hold, a Bitcoin ETF all over the world, and we see increasingly higher and higher inflows? And what would that do to the Bitcoin price? Now, another thing that to me was quite interesting to look at is to look at the adoption trajectory of Bitcoin versus something like the internet. And here I'm focusing on the right-hand chart, where based on the number of users, someone tried to estimate, how far along we are in the Bitcoin adoption compared to the internet adoption. And as of 2023, Bitcoin was roughly in line with where we were with internet adoption in 1999, at least based on the number of users. And the way that they thought about this is just, by looking at the different wallets that were out there. And at the moment, there's approximately 800 million to 1 billion active wallets globally that hold Bitcoin. And people estimate that that's around 400 million unique users because some people might have multiple wallets. I, for example, do. But what would that then actually mean in terms of adoption globally? Well, if the total addressable market is, let's say, 4 to 5 billion people worldwide who have access to the internet, who have smartphones, and a need for a digital, censorship-resistant, global and decentralized store of value and payment system, then 400 million out of the 4 to 5 billion people, that represents roughly 8 to 10% of adoption, which if we look at the typical S-shaped adoption curve that technologies like Bitcoin and other technologies always go through, that puts us, somewhere here on that adoption curve, which is well before the slope really starts to take off. Or if we look at it on a bell curve, we're still in the early market of this adoption. And you can see it here, the adoption curve you can find that for almost every technology, whether it's electricity, refrigerator, computer, or the internet. Now, let's get to the investment related part of this presentation, which is Bitcoin's role in a portfolio. And to me, there are really two roles that are very closely related. The first one is Bitcoin as a unique diversifier. So if we look at the charts that I'm showing here, the first one shows the 6-month trailing correlation between the S&P 500 and both Bitcoin and gold, Bitcoin in orange and gold in yellow. And what we can see is that both Bitcoin and gold move through different phases where they're slightly positively correlated with the S&P, slightly negatively correlated, or uncorrelated. But on average, over the long run, and I haven't updated this since last year, the average correlation is actually pretty low to equities. And down here, I'm just showing Bitcoin versus the S&P versus gold and versus bonds. But the story is basically the same, which is that it has a pretty low correlation to most assets that you typically find in a diversified portfolio. And why is that the case? I mean, if you think about it, if Bitcoin really is this global, decentralized, fixed supply, non-sovereign asset, then you would also expect it to have distinct risk and return drivers over time compared to these traditional asset classes. And therefore, you would expect it to be fundamentally uncorrelated over the long term. Now, the short-term market behavior can diverge from this. And we've seen that recently with Bitcoin being, more highly correlated to equities, especially tech stocks. But over the long run, you would expect to see something like this. And that's because the adoption drivers for Bitcoin are likely to be completely distinct from, or maybe even inverted with those global macro factors that you see for equities, for bonds. And it should probably be more similar to gold over time, which is, I guess, this established safe haven asset, hedge against global uncertainty, and also store of value. Now, very closely related to that is the second case for Bitcoin in an investment portfolio, which is as a sharp enhancer. What I did here is I just modeled the typical 60-40 portfolio and added 1%, 2%, and 3% Bitcoin allocation to that from 2014 until early 2025 in this case. And what we can see is that with each additional percent invested in Bitcoin, the return goes up a lot, the annualized return. But the volatility, and this is the key part here, but the volatility barely increases even as we go from 0% to 3% invested in Bitcoin. It goes from 9.2 to 9.4%, which means that the Sharpe ratio, the risk-adjusted return, what we really care about, also only increases with each additional percent invested in Bitcoin. And why does that happen? Well, it happens because over that time period, Bitcoin was probably the best performing asset in the world. It had really high returns. And yes, it was super volatile. But because it's so uncorrelated to the other two parts of this portfolio, which is, global equities and bonds, that volatility basically was diversified away through the rest of the portfolio at such a small allocation. And all that you were left with is the excess return, which boosted the Sharpe ratio of that portfolio. Now, lastly, the one thing that I want to finish off on is making that clear distinction between Bitcoin and the rest of crypto. And as I said in the beginning, this is something where a lot of people still are confused and put everything into the same bucket because, that's how it's portrayed in the media. And everything is called a cryptocurrency. And at the end of the day, they all use cryptography and are somewhat similar in what they use, which is, blockchain and cryptography. But there's some really important differences. And the way that I'm going to make that distinction is by comparing Bitcoin to Ethereum. But a lot of the stuff that I say about Ethereum can be applied to almost every other crypto asset that is out there. And some of the key differences that I maybe want to highlight here is, first of all, the value proposition. For Bitcoin, it's really just that it's this internet native global monetary alternative and store of value. Ethereum, on the other hand, tries to be a programmable platform for decentralized applications. So completely different thing. It's almost like a tech platform or something like that, whereas Bitcoin really only tries to be something like digital gold, just sound money in the digital age. And that's it. Like that's literally all that Bitcoin tries to be. So everything that I said up until this point, about the history of money, about the properties of an ideal store of value, all of that only really applies to Bitcoin. None of that applies to Ethereum or any of the other crypto assets that you find out there. In terms of level of decentralization, there's also a bit of a difference. Bitcoin is super decentralized. There's hundreds of thousands of people running nodes all over the world, and there's no one person or group of people that has centralized control over the direction of Bitcoin. Whereas for Ethereum and a lot of other blockchain technologies out there, they usually have what's called a foundation or an insider team that's basically like the leadership team of a startup or something like that, has a lot of control over the direction that that crypto project is headed towards. The monetary policy for Bitcoin is also fixed, pre-programmed, has never changed, and will never change. That's game theoretically basically guaranteed. Whereas for Ethereum, it's changed 3 times since 2021 and is expected to change again. Bitcoin also uses proof of work, whereas a lot of other crypto assets use proof of stake. I'm not going to go into the details about those, but the difference actually is really, really important. And if you look at the traditional finance comparables for both, for Bitcoin, this would probably be gold and alternatives. And for Ethereum, this would probably be venture capital and early stage tech startups. And it's not just me saying that. I've got a photo of a slide that BlackRock presented to their clients, like high net worth individual and institutional investors, where they also clearly made a distinction between Bitcoin and called it this global monetary alternative, classified it as risk off, and the illustrated funding sources were also gold and alternatives. And Ethereum is more a bet on blockchain adoption. It's risk on and more similar to equities and venture capital. So I just want everybody to understand that while these things often get grouped into the same bucket, fundamentally different investment cases, but also different things that they try to be. And it's totally okay. Like Bitcoin only tries to be sound money in the digital space. All the other ones try to do really cool stuff that's more like technology stuff, but completely different things, completely different investment cases. And that's one of the key takeaways here from my side. So yeah, that's my presentation.
That's excellent. That's excellent. Thanks, Jonas. We'll open up for some Q&A shortly, but I did just want to bring it more in the context of like how we can deal with that, because as officially of last Wednesday, our licensee right across the board has allowed us to advise in the Bitcoin space. What does that mean? It basically means that whilst we can't talk about Bitcoin as a commodity, like if someone wants to just store it in a wallet on an exchange, we can deal with it and give advice on if it's what we call wrapped in a product. And in this case, it's an ETF, an exchange traded fund. And that's how we can deal with it, because it's regulated and so forth. And it's on obviously a lot of different platforms. And for us, FMG, we've always had an investment philosophy around a core satellite approach. A little bit of a universal flavor there, which is important to us. If you could think of like an orbit with a core that is made up of somewhere between 60 and 85% of what we may call low cost index funds, and then surrounded by that, we have what we call specialist satellites. So the core's more passive, but the satellites are more what we call specialists. And whether that's US shares, international shares, whether it's Aussie shares, whether it's infrastructure, property, and so forth. If you could imagine Bitcoin as an allocation, and to start with, we can work with up to a maximum of 3%. I'm sure over time that may well go up. I'm sure it will, but that's what we can work with at the moment. So what that means in essence is that when we give advice for example, an existing ongoing client, we can build in that allocation of 3% of their portfolio as part of an ongoing client. And for a new client, we would have to obviously do an advice document because we're recommending a product. And the same thing there is we would use what we call our core satellite approach or offering around our investment philosophy, and use Bitcoin as a satellite, a specialist satellite. So I think that's sort of an important distinction to make was, well, how can we use it and how do we deal with it? We can't deal with Bitcoin at its raw commodity on an exchange or, with wallets. We would have to deal with them as a regulated product that the Bitcoin is held institutionally, institution grade storage and so forth. So I just wanted to share those last couple of slides because I think that's important on how does that all play in an advice practice, giving advice around using Bitcoin. So that's it from me on that part. What I thought we might do is I think Joy will be able to let whoever wants to have some, we'll do a Q&A session. And I mean, I've got a couple of questions for Jonas, but by all means, please, if we've got a little bit of time, if anybody's got any questions on the presentation, I do want to let you all know though that we will send out in the next day or two a copy of the recording, so you'll all get a copy of that, which will be great. You can watch it, you can share it with whoever you may want to. I just thought it was important that this first webinar we did on this was really just to clients of ours or subscribers to our newsletter and not go out into the ether, which I'm sure eventually we will. But we'll open it up, and if anyone's got any questions, please, you should be able to turn on your mic and your camera or pop something into the chat. Please do so. And while we might be waiting for something, Jonas, if I've got a question for you, if that's okay, is one of the things that, and you did mention about the yield, like earning money, dividends, income yield, so forth. That gets asked a lot about Bitcoin. What I wanted to just, we mentioned if we could think of Bitcoin as the foundation layer, or what we call layer one. They are starting to build products on what we call layer two. You mentioned the Lightning Network. That's for transacting, but they're also building products such as what we call digital credit products that allow to pay a yield or a dividend, for want of a better word, or interest, call it what you like, on Bitcoin. And the couple that I know we don't have anything available in Australia, but in the US, there's like Strategy has a product called Stretch or STRC, and also Strive has a product called SADA, who are paying interest. Strategy at the moment is paying 11.5% yield on Bitcoin over, I think they're paying it monthly, but they're looking to go mid-month, end of month. And SADA, which is from Strive, have just released the same thing where they've got a huge reserve of Bitcoin as the capital, and they built a product on top of that to give a yield. And they're offering at this stage 13-something% paid daily, which is something quite new. What could you share about that next stage of offering products? Because we have heard the Commonwealth Bank is looking at some of these products. What could you share there?
Yeah, I mean that's a good question, and it's one that I guess people have been talking about a lot recently, because STRC, Stretched by Strategy, I think is probably the most traded and one of the most popular preferred stocks that's trading worldwide at the moment. And yeah, you're right, it pays 11.5% annual dividends at the moment. But again, I wouldn't necessarily say that yield is on Bitcoin itself. It's more that they have a preferred stock, and their whole business is a Bitcoin treasury company. And I guess the theory behind it is almost to bet on Bitcoin growing more than the dividends that they will have to pay percentage-wise over time, and being able to keep borrowing against their Bitcoin or issuing more stock, and thereby continually playing this game where they basically either borrow fiat and buy more Bitcoin, or find other ways to buy more Bitcoin. And I mean, there's also other firms. I mean, Coinbase does this as well, where they offer you to lock up your Bitcoin in exchange for a little bit of yield. But as soon as you do that, like I said, like there is no free lunch. As soon as you get yield on anything, it comes with a risk. In the case of STRC, the risk is that they can cut the dividends at any time. Or strategy, what if the Bitcoin price really, really crashes for a prolonged period of time and they run into solvency issues? It's, the 11.5% isn't guaranteed. They can actually cut that at any time. So while it works, but you're taking on that risk of that eventually not working out anymore.
That's interesting. So really at this stage, we see Bitcoin as a store of value. And in our case, we can have a small exposure of up to 3% in a portfolio. And as you saw with that, you had that chart, which was great, that showed 60-40, and then you introduced 1, 2, 3% of Bitcoin, that the actual return went up. And notice that thing called a Sharpe ratio. Could you just explain what the Sharpe ratio represents? Because it was almost 1%, and that's 1, and that's really, it's really important to know what that means.
Yeah. So for those that may not be familiar with the Sharpe ratio, it's basically just a financial metric that we look at in the investment space all the time, because it divides the excess return of either an asset or portfolio by the volatility of that portfolio. So you can think about it as a risk-adjusted measure of return. So how much return are you getting for each unit of risk that you're taking on? And a higher Sharpe means that you're getting more for the risk that you take on. You're getting more bang for your buck, essentially. And that's how you can compare assets with different levels of volatility or risk as well, because the Sharpe measure adjusts the return for that risk and makes it all standardized and comparable, if that makes sense.
Well, I might ask one more, maybe just in case anybody's got, they can ask a question. But where do we see this going, Jonas? Because I have heard like the Commonwealth Bank here in Australia has been at a very high net worth level, been having Bitcoin as collateral for borrowing against. And I'll be honest, that was one of the first things that really intrigued me, was that if this is a store of value that keeps going up in value and you can borrow against it, that really intrigued me. Where can you see this going in the future?
Yeah, I think you're completely right. I think, in my opinion, Bitcoin will start to be recognized more and more as pristine collateral, something that you can borrow against, just like, wealthy people nowadays, and, they have been doing it for the last couple of decades, is if they have a lot of real estate, they don't sell the real estate if they need more capital. They borrow against their real estate because it is a good store of value still, and it retains that purchasing power over time better than fiat money, but it doesn't require them to sell it. So, or you can borrow against shares or whatever, like other assets you have. And I think Bitcoin will fall into that category pretty soon. And you can already see it with, I mean, there's Block Earner here in Australia that already allows you to borrow against your Bitcoin to get a deposit for a mortgage on a house. In Germany, there's a company, Firefish, that allows you to borrow against your Bitcoin. In the US, you have something called Ledden, which allows you to borrow against your Bitcoin. And there's a lot of US banks that are starting to talk about combining Bitcoin and real estate into, one collateralized loan, where the collateral isn't just the real estate or just Bitcoin, but both of them combined, because it's actually uncorrelated assets and provides better collateral for the bank. So it's actually a less risky loan to give out than just the real estate loan or just the Bitcoin loan, which is an interesting concept as well.
Yeah, oh no, that's excellent. Thank you for that. And you just touched on a really important point, is that up until Bitcoin, it was commonly known, or it was known, that the top 1% of the wealth around the world, they don't, for them, like you mentioned, they could be holding real estate in New York or wherever. And as that value of that real estate would go up, they wouldn't necessarily, as you mentioned, sell any of that, but they would just borrow against that money, and then using the borrowed funds to live off, because it was just a very small proportion of the value of that property, they don't trigger any tax event. So they're really, having tax-free income. So Bitcoin's probably, I'm sure, the first asset that people can look to take advantage of it in that way. That was probably only once upon a time for the 1%, wealthiest people in the world.
Yeah, true.
Yeah. I'm not sure whether anybody else has got any questions or not. Like I said, we will get out a recording to everyone in the next day or so. Jonas, I did want to thank you for coming along. Thank you so much for giving up your time this evening. And thanks for everyone for joining us tonight. Really appreciate it. We've just gone over the hour mark. I think we did allow an hour and 15, but if we don't have any other questions, we will send out the recording. If you do want to follow up and have a chat about how that may affect you, or you'd like to know a little bit more about it, please do. But we thank you for jumping on the call tonight. Thank you, Joy. Thank you, Jeeple girls, for facilitating that in the background. Thanks again, Jonas, and have a good night, guys.
Thanks, everyone. Have a good one.
Thank you, mate. We'll be in touch.
Cheers, Arthur.
Good.